The US labour market sputtered in November over high fuel prices and fears of an imminent economic slowdown due to a resurgence in COVID-19 cases. Only 210,000 new jobs were reported last month, much lower than analysts' expectations of around 570,000. The unemployment rate fell sharply to 4.2% as the number of people leaving the job market increased. Meanwhile, continuing unemployment claims have fallen below 2 million for the first time since the start of the pandemic. We're joined now by economist Joann Weiner in Washington, D.C. She's the Director of Applied Economics at George Washington University. Thank you very much for being with us. The job growth in November was less than half what analysts expected, and it comes after a strong showing in October. What's behind this surprise drop?
You know, the labor market has been bouncing around quite a bit for the last few months. This past time, it is quite a shock that the numbers came in at less than half what was expected. We expected about 500,000 jobs creation. So there's mixed signals out there. Supply chain problems are continuing. The Fed's tapering or slowing its tapering. Consumer confidence has been falling, yet wages are rising and unemployment rate is down. So it's definitely a mixed message out there with today's economy.
Right, and we'll come back to that in a second on the mixed signals that you were hinting at. But I'd like to ask you also, is this enough for the Fed to change its mind in terms of the tapering that it hinted at?
Yeah, you know, the Fed faces a tricky challenge right now that with again, to repeat myself, the mixed signals out there, is inflation a real problem? Is it transitory? The latest thought is that inflation is not transitory. So perhaps inflation is a bigger problem than the Fed had thought a few months ago. So now they need to stop buying bonds and need to tighten up so that to keep inflation under control. The labor market doesn't seem to be such a problem in terms of the unemployment rate. But again, we get these numbers that are disappointing for today. So the Fed has a challenge ahead of itself.
Right, and the participation rate as well. I mean, it's stagnated, it slowed down with COVID, with the pandemic, but it never really jumped back. How tight is the US labor market really?
The labor force participation rate is really astounding, that people are leaving the labor force. That is not due to government payments because the checks more or less have stopped coming. People, I think, are saying that they don't like these working conditions. They don't want to work under Corona. They want to have more stability in their hours. They want more control over the time that they work. And that ongoing childcare problem, of course, means that a lot of people can't go to work. So that is a new low. I don't know if it's a new low figure, but labor force participation certainly is falling. And so, but people are getting by. And the fact that we're going into the holiday season and economists are not expecting there to be necessarily an uptick in employment means we're going to have a rough winter coming up.
A rough winter, and lastly, on the Omicron variant, I mean, it's early to really see its effects, but how can the current picture be affected by the new variant?
Well, I'm going to be one of those people that says it's too early to say how bad the impact of Omicron will be. It is unfortunate, of course, that we have yet another variant of the coronavirus coming out. It's going to make people even more hesitant to get back to normal lives. As you pointed out, we're heading into our second winter of Corona. Shutdowns don't seem to be very popular. The mandates are not. We're not getting many more people vaccinated than we had before. So we seem to be in a real trough in terms of getting people to get vaccinated and wear masks and take steps needed to slow the pandemic. That's a huge challenge in the United States.
Joann Weiner, many thanks for being with us today.
You're welcome.